Mind over markets, James Dalton. Every price on a chart looks like a fact once it has printed, but a market never intends it that way. Each tick is closer to a question the market is asking out loud: will anyone trade here? This is the book that turned that single insight into a complete, teachable way of reading a session, and decades after it first appeared, it remains the standard entry point for anyone who wants to understand a market as an auction rather than a picture. Core thesis. James Dalton spent his early career inside the market's own machinery rather than observing it from outside. He traded on the floor of the Chicago Mercantile Exchange, held membership at the Chicago Board of Trade and the Chicago Board Options Exchange, and was recruited in 1973, shortly after the FIBO's founding, to become its first marketing director before rising to senior executive vice president. He went on to run hedge fund research for UBS Financial Services, and in 2010 turned decades of floor-level pattern recognition into a teaching curriculum he still runs. Dalton did not invent the charting technique this book is built around. That belongs to Peter Steldmeyer, a Chicago Board of Trade floor trader who developed Market Profile in the early 1980s. Dalton, together with co-authors Eric Jones and Robert Dalton, took Steldmeyer's graphic and built it into a full, teachable framework, first published in 1990 and updated in 2013. The claim underneath it is simple to state and takes a career to internalize. A market exists to do one job: to facilitate trade, and it does that job by continuously auctioning price up and down until it finds a level that draws in participants on both sides. Dalton frames a reader's own progress through this material as a journey from novice to competent to genuinely expert pattern recognition, a warning about how long this way of seeing a chart takes to become instinctive. Price is a question, not a verdict. Auction market theory starts from the premise that price is not a verdict on value, it is an advertisement. Every price silently asks whether anyone will trade there. If participants on both sides answer yes, volume builds at that level and time accumulates there, and the market has found something close to fair value for now. If a price fails to generate two-sided interest, the market has its answer and it moves on to advertise a new one. This splits the two things every trader watches, price and volume, into two different kinds of information. Price tells you where the auction currently sits. Volume and the time spent at each price tells you whether the auction is actually succeeding there. A price with no time or volume behind it is not support or resistance in any durable sense, simply a level the auction passed through on its way to somewhere more agreeable to both sides. And that distinction is the seed every other idea in the book grows from. Building the profile, Market Profile's actual mechanic, is the time price opportunity, or TPO. The session is sliced into successive brackets, 30 minutes each in the classic convention, lettered in sequence. As price trades through a level during a given bracket, that bracket's letter prints beside that price, and over a full session the accumulated letters build a sideways, lopsided histogram, full and rounded, where price kept returning across many brackets, thin and tapered where it barely visited. This is a genuinely different object from an ordinary candlestick. A candle shows the open, high, low, and close for a fixed window, but says nothing about how long price actually dwelled at any level inside that range, or how many separate decision periods agreed to trade there. The profile is built to answer a different question than a candle does, not simply where price went, but where the market actually spent its time, the more honest picture of where the auction is truly being resolved. The point of control in the value area. Two structural reference points come straight out of the TPO count for a session. The point of control is the single price with the most TPOs recorded against it, informally the fairest price of the session. The level the widest range of participants across the widest range of time brackets kept agreeing was acceptable. The value area is the price band containing roughly 70% of the session's TPO count, built outward from the point of control by adding whichever adjacent row currently holds more TPOs until that threshold is reached. That 70% figure is a deliberate echo of one standard deviation under a normal distribution because the profile's rounded shape is at bottom, a bell curve turned on its side. The Osiris Capital Trading Desk keeps this same logic on its own map of a session. Levels are weighted by how often the market has actually returned to and defended them. So a price with a long history of real two-sided trade earns more respect than one that simply sits nearby. The initial balance and who moves beyond it. The initial balance is the range established during the first two brackets of the session, roughly the first hour. Dalton's insight is as much about who sets it as what it is, generally short horizon liquidity providing participants, floor locals and fast scalpers probing for orders rather than committing real directional size. It is a provisional reference range, not yet a verdict on the day. Range extension is any trade beyond the initial balance, high or low, where the framework earns its keep as a decision tool rather than a charting curiosity. The participants who set the initial balance generally lack the size and conviction to push a market meaningfully beyond its early range on their own, because they exist to facilitate rotation, not to relocate value. So when the range genuinely extends and holds, rather than poking through and snapping back, Dalton's read is that a longer horizon participant, an institution or a fund, has stepped in with real size because they believe the prior price no longer reflects fair value. Asking who is actually behind a given move is, in this framework, close to the single most important question a trader can ask. The Osiris Desk's read of the opening minutes of a session runs on exactly this premise. It maps the early range as it forms and watches for genuine extension and hold rather than a brief poke through, because that difference is the entire distinction between a session beginning to trend and a session about to rotate back into it. Balance and imbalance. Everything above compresses into a single fractal read. At any given moment, on any given time frame, a market is in one of two states. Balance is the default, most common state, two-sided and rotational buyers and sellers, both roughly satisfied with the range on offer. Time and price circling back to a shared idea of where value sits. Imbalance or price discovery is what happens once one side has taken genuine control and the market stops rotating to search outward for a new price that will draw the other side back to the table. The resulting profile thin and elongated because price is moving through levels rather than settling into them. Critically, this RID is fractal and depends entirely on which time frame you attach it to. A market can be in imbalance on today's chart while still sitting inside a much larger balance on the weekly chart, or the other way round. And asking which state a market is in only means something once a time frame is named alongside the question. The Osiris Desk grades the opening minutes of every session through exactly this lens, reading whether the first prints are rotating inside a range or driving away from one in real time, and carrying that read into every call that follows. Responsive defense, initiative attack. Dalton pairs the balance and imbalance raid with a matching red on the behavior generating it, arguably the book's most practically useful contribution. Responsive activity trades against a move away from established value, effectively betting on a return to it, selling as price pokes above the value area high, buying as it dips below the value area low, the natural behavior of shorter horizon participants with no real thesis that fair value has changed, simply fading the extreme back toward the middle they still believe in. Initiative activity does the opposite on purpose, pushing price away from established value because the participant genuinely believes a new value is warranted, willing to pay a worse price than recent consensus precisely because they expect that consensus to shift in their favor. The payoff is practical. When price tests an extreme, the real question is never simply whether the level will hold. It is whether what you are watching is responsive defense or initiative attack. A level being responsively defended is a fade. A level being initiatively attacked may not hold at all. The Osiris Desk draws this exact distinction out loud when it names a setup. A test of a level is framed either as a fade worth joining against the move or as a break worth joining with it. And the naming depends entirely on which of the two behaviors the tape is actually showing. 5 shapes a session can take. Dalton catalogues 5 recurring session shapes, each a different balance of initial balance, range extension, and closing location. The normal day carries a wide initial balance that ends up containing nearly all of the day's eventual range, a rounded, well-distributed profile with little to no genuine extension, the purest expression of balance. The normal variation day is the most common type in practice, a moderate, one-sided extension beyond the initial balance without a full directional trend, building onto its early range rather than escaping it. The trend day drives persistently in one direction almost from the open with minimal rotation, so the initial balance ends up as a small sliver of the day's total range and the profile prints thin and elongated. The double distribution trend day pauses mid-session to build a brief secondary balance area before re-zooming in the same direction, printing two rounded humps joined by a thinner bridge. And the neutral day sees both sides of the initial balance genuinely taken out during the session, closing either back near the middle of the resulting range. Effectively a wide balance day in disguise, or near one of the two tested extremes, effectively a late developing trend day. The fine print, excess, and unfinished business. Three supporting signatures round out the vocabulary. Single prints are a column where only one TPO letter appears at a price, meaning exactly one time bracket, ever traded there before the market moved on. Physical evidence of strong initiative conviction that can act like a magnet if price ever returns to that zone later. Excess or tails is a short, sharp rejection at a session extreme where very few TPOs print before price snaps back the other way. Evidence the auction found a genuine boundary more likely to actually hold. And a poor high or poor low, sometimes called unfinished business, is the opposite signature, an extreme where multiple brackets trade repeatedly at the exact same price without ever producing a clean rejection. Evidence the auction never properly finished its business there and is likely to return and complete it later. Bottom line, this book's lasting contribution is a working vocabulary for something every trader watches, but few can actually describe: the negotiation happening underneath the price, the point of control, the value area, the initial balance, and the balance and imbalance read are not decoration on top of a chart. They describe how a two-sided market actually behaves, and decades after publication that vocabulary is still the closest thing this corner of trading has to a shared language. A vocabulary only matters once it changes what a trader actually does at the open, and that is the harder half of this book. The Osiris desk was built to make that leap for you, an advanced platform for trader development and disciplined trade management, and the flagship of Osiris Capital. It reads the overnight and previous day levels before the first bar prints, weighs the opening range for genuine extension rather than a passing poke, and grades the session's early character as balance or imbalance in real time, because that grade decides how the rest of the day's calls get weighted. It reads every open through exactly this auction lens until seeing a session the way Dalton describes it is simply how you trade.